All right, what's going on? Even I Can Traders, we are back. Today is February 25th. It's the weekend. And I know I haven't been uploading as much. I've got some stuff at work to deal with. So that's taking up a little bit of my time. But I wanted to fill you in on how we've been doing because I still have been trading. If you were in the Discord, you could see all of the trades that I do pretty much live. We're starting to get some people in there now, so this conversation is starting to lively up a little bit. So very happy about that. But we're still going, even if I'm not uploading videos. We're still up in here, and I'm still showing my daily trades and everything. So go ahead and get in. I've got the server up for a trial. So when you join the Discord and you want to see my trades as they happen, all you got to do is sign up for this particular tier right here. You get a 1 week free trial, and you can see all the trades live as they happen, and you will get an alert to your phone if you have the Discord app. So you can always stay up to date with all of my trades. And this tier is going to give you access to the spreadsheet that we're about to look at as well. And if you do happen to want one-on-one coaching, I've got like 10 spots available for that. But you can sign up for that, and I will coach you one-on-one. So anyway, what I wanted to go over here is our progress first. And then after I talk about our progress, I want to talk about just give an overall overview of my strategy, because I feel like I refined it some, and I'm not sure if I really have an overall video talking about exactly what I'm looking for all in one thing. So it's going to be a little bit of a longer video, so I apologize about that. But I wanted to talk about the overall strategy and what we have going on. So far, as far as the results, once again, I started with $500 in this account. And this is a test account, so it's not real money, but I am trading real money on the back end with my own account with the same trades. That helps because when you're trading with a paper money account, at least on Thinkorswim, the fills that you get are absolutely unrealistic. So what I do is I trade in my real account and then do the same trade over in the fake account and make sure that the fill lines up with what I can actually get in the real world. So these are actual real trades. They're just not done in a real account or in this real account, but the trades are done in a real account first. So anyway, here's where we are. We are 78 trades in and 74 winners and 4 losers in 40 days since we started. And the account literally just crossed $2,000 as of Friday, which means compounding. We get to compound, and we were having some fun with that in the chat here. So we get unlimited interest. But yeah, so we get to compound next week and add a contract to our trading if we so choose. Now you can do this one of two ways, depending on how conservative you want to be. You can just use all of your buying power if you want to. I don't really recommend that unless you're maybe at like just starting out at like $500. But if you're like, $1,500 or more, I would probably leave a contract in reserve so that you can have some room to move around and do what you need to do. But maybe $1,500 or less, then okay, use your full buying power. But above that, I would stop using your full buying power, which I've done here. So this whole time I've been trading with 2 and 3 contracts, and not using the full buying power. Now we have the ability to trade with 4 contracts, but I'm going to stick with 3 going forward. Okay, until we get to 2,500, then I might move up to 4, or I might stay with 3. Just depends. But the point is, I'm trying to leave more and more money in reserve just in case. So you can see here's all of the trades on the spreadsheet. We haven't had a loss since February 9th. And I do want to talk about that when I get there. I'm going to use that date as an example. But we haven't had a loss since February 9th, and we've traded every single day. And I think I've settled into a good rhythm as far as where I feel comfortable with making this pretty much a repeatable system. It's survived a lot of differing market conditions. Not everyone, but a pretty good amount of 40 trading days is a pretty good amount. That's like 2 months worth. of data. And we've experienced up markets and down markets in that particular time. So, it's not fully representative, but it is a good data set. So I think I've settled into a good rhythm there. And we're basically doing 25-cent iron condors, but we are legging into them at 15 cents and 10 cents. So I'll go over that in just a moment, but that has resulted in an average rate of return of about 4.4% per day. So you can see all the data right here. We're averaging about $35. This is inclusive of the smaller trades and everything like that, but averaging about $35 a day right now, actually more than that now, but this is, like I said, is inclusive of all the trades, even the smaller ones and the losses and everything like that. So we're doing pretty good. Our profit expectancy is up. We're at 281% profit over 40 days. So pretty strong start here, and we are definitely poised to continue. So if you want access again to this particular spreadsheet, as well as the wealth calculator that I have here that I'm using to kind of pattern out what I'm doing, that's going to be available in the Discord under the premium member subscription. So you can have access to that as well as the trades on this one. And most people actually get this one. So pretty cool there. So what I want to talk about is what I'm doing. What is my system? What am I looking at when I'm making trade decisions? So I want to go over that pretty much in its entirety, or as much as I possibly can. So basically what we're looking to do is we're looking to set up an iron condor. Iron condors, when you're looking at trading spreads, are very capital efficient, twice as capital efficient as doing just one side of the market. But with that efficiency, you're going to get double the risk, basically, because you have risk on both sides of your trade instead of just one side. So you are doubling the risk. So my philosophy here is obviously to get as far away from the market as possible, but the market is going to move around. It's going to move up and down during the day, and it's going to put in a high and a low at some point in the day. Now, we don't know where that point is going to be. That's the rub, right? What's going to be the high, where the low is going to be in the day, have no idea, right? But we can make reasonable assumptions, or we can make guesses based on data, and hypothesis based on data, and get some sort of reasonable expectation that this is pretty low for the day, or this is pretty high, most likely for the particular day. If we can identify those points, we can lessen our risk, because we can make our iron condor even wider than if we just plop the iron condor down at some point in the market and expose ourselves on one side or the other, because we know the market's probably going to go, trend upwards or trend downwards at some point. And if we plop an iron condor down when the market is at a low point and it rebounds, it's going to endanger the other side, the top side of our iron condor. And that's why a lot of iron condor traders fail and get taken out a lot of the times, because if it's a good time to sell a put spread, it's a bad time to sell a call spread, most likely, and vice versa. So what we're doing is we're accounting for that by just selling the put spread when it's a good time to sell a put spread, and trying to sell a call spread when it's a good time to sell a call spread. And that way we get that same exact capital efficiency that iron condors bring, and we lessen our risk because we are taking market movement into account with our trades. So what I've settled into right now this is probably going to change at different account values, but when we're talking about low dollar amounts, what has worked well for us so far is doing the SPX. And there's several reasons for the SPX. I actually listed out on my spreadsheet in there, so you can check that out. But we use the SPX, and we do 5 wide spreads. That's going to be $500 of capital use, okay, on each side. So it's a total commitment of $500 from your broker. And we are going to do 15-cent spreads and 10-cent spreads, just depending on how the day goes. So what I like to do is I like to try to find my 15-cent spread first. So if the put spread is what I'm looking at for the day, for whatever reason, I'm usually trying to get 15 cents out of that. If the day starts out looking more like I'm going to do a call first, then I'm looking for 15 cents on that side. And then once that trade looks good, looks secure, looks like I'm comfortable with that particular trade, and I may not need to do any more moves for that day, then I will look for the opposite side of the market and do a 10-cent trade on the opposite side of the market. The reason I'm doing a 10-cent trade is because I can get even further away from the market with those trades, and I don't have to worry usually almost at all on a 10-cent trade unless I'm just completely wrong. But usually I don't even really have to even watch a 10-cent trade once I have it placed and everything. And that means I can go on about my day. So I'll give you an example of that with Friday's trading. So Friday was beautiful. It's a beautiful trade, lovely trade, and almost perfect positioning. So here's the market for Friday. Try to ignore all the other little lines and stuff like that. But Friday started out, we got some bad news. We had a big gap down, a huge gap down actually from here. And we had almost a gap and go, but we did start to find support around S2. So this red line, let me just move this line out the way. So this red line right here is S2. Okay, I'm not sure if you can see that, but we started to find some support around S2. I identified that. I even said it in the chat. Looks like we're getting some support. And I had made a mistake on the previous day by ignoring my stochastics. And I'll go into how I use this, but I kind of used my stochastics wrong and got into almost a little bit of a trouble situation the day before. So today we had almost the same setup, and I waited for stochastics to look the way I needed it to look. And again, I'll go over that in a few. But that made all of the difference. So I got in a good trade on an upswing right here. This is what you want when you're trading spreads, right? So we're essentially playing keep away. I don't know if you remember the game Operation. Maybe I'm a 90s baby or something like that, an 80s baby, and it was big back then. But if you don't remember, there's a game called Operation where you are essentially trying to keep away from the sides of the game. And if your tool hits the side of the game, you get buzzed. That's essentially what we're trying to do. We're trying to play dodgeball with the market, right? So when I do this put spread, I want the market to have already done its damage to the downside, okay? I want the market to already have made whatever move it's going to make and try to find a low spot for the day and identify what that low is, or is reasonably close as I think I can get. And then I want to trade below that. Okay, so what that's going to do is it's going to give me all kinds of error room, all kinds of space in case I'm wrong. So here we got lucky and we did identify the low of the day, which was actually right here. So once I saw this low get rejected, I saw the stochastics come into range, went ahead and placed a put spread trade down here, way down here, and the market continued up. And that's exactly what you want to see when you place a put spread. You want to place a put spread when the market starts to curl up and starts an uptrend, or during an uptrend, right? That's the best, because you're just immediately in the green and going to stay in the green for a while, and you give yourself a lot of buffer room for the market to have to reclaim a lot of ground to start to endanger you. So this diagonal line that I draw from where I place the trade down to the expiration, that's kind of like my danger zone. Okay, so underneath this line is pretty much danger zone. This is like red alert or yellow alert, whatever you want to call it. This is your alert, right? You're not getting out of the trade necessarily, but you're looking at it, right? Above this line, you're okay. The further above this line, the more okay you are, and the better your trade is going to look. Okay, So what you want is you want to get a nice lead on the market, which we did right here. The market continued to go up. It continued to go up, and it made our trade better and better and better, because you have to remember that this is about time. So the more time that the market spends going up and away from your strike, the better things are for you, because the market takes time to move in whatever direction it's going to move. So if it's taking time moving up, that means that that is time that it is not taking to move down. So when the market does move down, it doesn't do it instantly. It does it at an angle. It does it during time. It takes time to do that. And even though this is a severe drop, since we have this much of a lead on the market, it's okay, right? We're not worried at that point. So again, what I tried to do is I tried to identify a high. I saw a high point. I waited for things to look like I wanted them to look, and actually got in a call spread right at this point. And that was like a perfect trade, which is rare. But we got in a perfect call spread, and this was a 10-cent call spread. And I chose this particular spot because it was above this little swing high right here. It's above this gap fill. So if you know anything about gap fills, you know the market loves to fill gaps eventually. So I didn't want to risk the market trying to come back and fill this gap, which it did a similar thing earlier, not too long before this, where it had a severe gap and then it came all the way back to fill that gap. So I didn't want to risk that. So I made sure I stayed above the gap and got a nice easy trade, which led to a nice easy day. I didn't even have to watch the market at all. So this first trade was my 15-cent trade. Once I felt that was secure, once I felt that one is going to go well, and I don't really have to do much with it or watch it, then I move to the other side of the market and I try to find a 10-cent trade that I also don't have to worry about. And the 10-cent factor makes it much easier to not have to worry about it. So instead of a normal iron condor, which if I did an iron condor when I traded this initial put spread, I would have been probably 20 points lower on the high side, which still would have worked, but you never know. You don't have the luxury of knowing what the future is. But this gap right here bought me an additional 17 points of safety, 17 points of risk that I don't have to worry about in the width of my iron condor. And that's what I like to see. I like to see a gap between my fills, if I can get it, for my iron condor. And that leads to a nice wide profit zone for the market to be able to move around, do whatever it wants to do, and not endanger either of my strikes. So this is like a perfect trading day. Okay. So to the stochastics and how I use the stochastics in my trading. So I use that when I'm picking out a spot to place my puts and calls. So what I'm looking for, if you see the different color zones here, you've got the black area on the top and the bottom, and then you have this bluish area in the middle for your stochastics. So what I'm looking for is for a cross from the black into the middle area to signify a potential end to a trend or a reversal, or at least a slowdown. So it's not perfect, but it does work pretty well. Okay. So I used it here. The optimal place to get into this put spread would have been at this particular low right here. But what can happen is it can just continue to go lower. You don't know that at the time. So what I'm waiting for is confirmation for this trend to end and the market to reverse directions before I enter my trade lower. Okay. And the stochastics helps me identify that, because when by the time the stochastics is pushing up into the middle zone, we can see that we've made a higher swing high. So this is, this is a high right here. This is a little high point, little swing high, but it's a lower high. So we have our initial point right here, our opening range. We have a lower high, and then we have a lower high. So when we got a higher high, that is also a signifier that the trend is potentially reversing. We can have a confirmation or, additional evidence that the trend is reversing with the stochastics. So I see the stochastics starting to push into the middle zone. I see higher highs being made finally and higher lows being made. That signifies to me that the market is done for now with going down, potentially, right? So I have those two pieces of evidence. I have the price action telling me, I have the stochastics telling me I have a reasonable basis to go ahead and place a put spread below this and expect for the market to continue, at least for a little while, in the direction that it's going. Same thing for my call spread. So here, I actually did this a little bit early, but I did that because I was doing a 10-cent spread instead of a 15-cent spread where I would have had to get a little bit closer. But if I were sticking exactly to the rules here, then I would have waited for us to make a series of lower highs, which we did right here, and lower lows, which we were doing right here, right? So that signifies, and our stochastics started to cross from the top of the black zone into the middle area at about this bar, maybe this bar right here, something like that. So what I would do here, I wouldn't trade on the bottom of these bars at the bottom of these wicks. What I would do is wait for the market to kind of pop up a little bit and then try to place a call spread, maybe even right here, something like that. And that call spread would have worked as well. So that's what I'm looking to do. It still would have given me a gap between my trade areas. It still would have given me a nice lead on the market. If I waited for this bar right here, I probably would have been 10 points lower, something like that, but it still would have been fine. So that's what I'm looking for when I'm picking out my spots. Now, if you can watch the price action and read the price action and pick these spots, then you're gonna have a much better time trading. Okay, you're gonna have much better and more successful trades pretty much no matter what kind of trades that you do. I don't know how this would affect butterflies, but definitely with spreads, this is what you want, right? To be able to read this. So even if your game, if you're not trading like so far away as I'm trading and you want to trade closer, this is still viable, even more so, right? I just particularly like to trade far away because I want consistency. But you could trade even closer than I do and then exit early or something like that. All of this stuff is still valid and valuable for that type of trading. So if I go back one day, you can see we did the same things, but here is where I didn't follow the rule, and I should have when I got into my put spread. So the market kind of did the same thing. Well, not the same thing, but it fell off pretty early, and we identified the sell-off and everything like that. And I actually entered my put spread here early. I was just too excited, or whatever you want to call it, nerves, whatever you want to call it. And had I followed the rule that I just explained here, where I wait for stochastics to come back into the zone and I wait for higher lows and higher highs to form, then I wouldn't be in a situation where I was. So in this situation, I was in danger, because if I were to take that diagonal line that I was telling you about and do something like this or whatever, you can see that it's well below my diagonal line. Now, in a trade situation like this, you're not going to see all these green bars yet. You're just going to see this pointing straight towards your short strike, which you don't want, right? This is not comfortable, not a comfortable feeling at all. What I should have done is I should have waited for some higher highs to form, which at the time I was thinking, okay, here's a little swing high right here, but this is not a higher high. This is just a high, right? This happens all the time. I was thinking at the time, oh, the market pushed down once, it pushed down twice. It'll probably push down one more time. So let me go ahead and get in early. just so I could try to get as far away as possible. That was a mistake on my part. Now, we didn't get out of the trade. We didn't lose on this trade, but it was not a comfortable trade at all. This is sweatbox right here. All this is stress right here because it's chewing up very quickly all of the margin that I gave the trade, right? When the market is down here, I mean, your account is down pretty big, right? And if you trade on stops, you would have been stopped out even way up here, right? So this is not comfortable at all. This is where you start to feel foolish as a trader. This is where you start to second guess yourself. So what I should have done is I should have seen that the stochastics has not emerged into the middle area, which it did not, and waited for it to come up into the mid area. Had I done so, then I would have placed the trade around this area, probably on this green bar or the next bar or something like that. And the trade would have been a very comfortable, smooth, easygoing trade. But I didn't do that. On the call spread side, I didn't do that either, but I lucked out. Okay. And even this little pump right here, when you initially get into the trade, is not comfortable for the few minutes that it's doing. So this is like 10 minutes of time where the market is pumping again straight towards your strike. So that's not, even though I'm very far away, in your mind, you're projecting out. When the market has these big green bars on you and stuff like that, in your mind, all you see is like this, right? Until the market turns around. So it's not a comfortable feeling. And that's why you want to wait. So what I should have done on this day on the call spread, I should have waited till somewhere around this point right here, or even this point right here where we start to see it really make inroads into the middle area. But even if I wanted to trade right here, this would have been justifiable because it is falling into the middle area as far as stochastics. But I was not getting higher highs at this point. We just got a swing high, but not a higher, a lower high, So we want lower highs, which I guess you could say, yeah, this is a high and this is a lower high. So you could kind of still justify it with this particular area, but that's what you're looking for. Okay. And then, so I mention it, I'm also looking at my pivot points as areas of support and resistance. So here is a pivot point, and as a matter of fact, that's why I kind of stayed in this trade. I wanted to see if the market was going to honor this particular pivot point. Now, had the market gone 5 points lower, I would have exited the trade, but it didn't. So I wanted to see if it was going to honor this pivot point, and it went through it a little bit, but it eventually did honor this particular area. It's not an exact science, so it could go through it a little bit or away from it a little bit. But this zone, I wanted to see if it was going to honor this zone, and it did. Therefore, I stayed in the trade, and it worked out. But this is another thing that I'm paying attention to is pivot points. So I'm going to come back for a part 2 and finish up my strategy. So we'll see you then.